But the consequence of all this has actually left us with probably the most distorted, bifurcated macro cycle ever. And I'm a little worried that we're all kind of viewing everything through a distorted lens.
Welcome to Speak Up. I am your host, Anthony Scaramucci, on the Wealthion Network. Joining us today is Sven Henrich, founder, and he is the lead market strategist of NorthmanTrader. First of all, thank you so much for joining us. I enjoy your macroeconomic outlook, which is why we invited you on, sir. So thank you for coming on. So why don't we start there? 2025, what's going to happen? What should I be worried about?
Hi, Anthony. Glad to be with you. Well, first of all, I think to understand 25, we need to kind of clear the deck a little bit on 24 and 23. Obviously, we've seen really a smooth bull market. Every dip was bought, and we need to understand why that is. And that is primarily, from my perspective, easing of financial conditions. They peaked in terms of the tightening cycle. It peaked in October 22. And that's when everything flipped. And three primary drivers of the easing financial conditions, in my view, were one, the exorbitant U.S. deficit. We have added $5 trillion in debt since October 22, which is unheard of in the sense in a non-recessionary environment, 6-7% debt to GDP. That is stimulative in any setting. That's typically what you see during a crisis. Number two, Fed had a couple of liquidity facilities in there. Obviously, the banking crisis in March of 23 was one of them. But larger than that was reverse repo, which peaked also in 22 at around $2.4 trillion, and it's precipitously declined. In fact, in the tail end of Q4, that dribbled down to just below $100 billion. So $2.3 trillion added on top of that in terms of liquidity injections. And then, of course, we got tremendous buybacks by U.S. corporates flooding through the system, and they're supposed to actually come into about $1 trillion again in 2025. So you can view that as a continued positive in terms of liquidity, but we got to keep a close eye on how liquidity will evolve in 2025, and we can talk about that a little bit. But the consequence of all this has actually left us with probably the most distorted, bifurcated macro cycle ever. And I'm a little worried that we're all kind of viewing everything through a distorted lens. I mean, obviously S&P, NASDAQ have done tremendously. We saw 23, 25% increases in those in 2024. You look under the hood, things get a lot less impressive. In fact, think about this. NASDAQ NDX 100 increased by 25% in 24, basically. But equal weight NASDAQ, only 6%. The market really gravitated towards the few mega cap stocks that are themselves now at tremendous forward multiples and price to sales ratios. So it's a very, very concentrated market. If I look at, broadly, new highs, new lows on the broader stock market, in a typical bull market, what you would see is new highs in cumulative advanced decline on U.S. new highs, new lows. We haven't seen that, not even close. XVG, I don't know if you're familiar with that. It's the value line geometric index. It's like when you take an index, you put every stock at 100 and then watch them move relative to each other. Guess what? In 2024, it didn't even gain 3%. That's how weak the underlying market is. And it's concerning, right? Because I would like to see the proper broadening. And part of the reason I think we haven't seen the broadening is that while we have easing of financial conditions, you have it while in financial markets. In the broader economy, you don't. You get this big K-shaped recovery. So you got Wall Street party, you got Main Street pain, and that's causing issues. And we see that now with yields back up. in early 24, I published this article called The Cynic's Guide to Markets. And the view was watch liquidity, it should be bullish. And guess what? The fifth year of any 10-year cycle, don't ask me why, Anthony, it's a historical fluke. If you go back to 1900, the fifth year of every decade makes new highs. It's incredible. 2015 wasn't that great because we had weakness in the tail end of the year, but every fifth year has made new highs. And so from that perspective, historically, I have to say, okay, I should expect new highs. Of course, I'm a little worried that we have maybe front-loaded a lot of the gains in 2024 with this concentration of the market. But to the extent that we see yields reversing, we can see that big catch-up trade. And we can talk about, obviously, what the reversal or what may prompt a reversal. Some of it may be good, some of it may be bad, right? Because we have yield curves inverting, and the Fed now actually has a big problem because they cut rates by 100 basis points. Yes, the 10-year yield is up 110 basis points. It's all kind of backwards. And the Fed is now worried about inflation picking up again. Well, guess what? When you flood everything with liquidity, and asset prices go up, you create a wealth effect. And some of the Fed speakers have actually kind of started admitting to that in the sense that, retail spending and growth is held up by the wealth effect because asset prices go up, consumers feel wealthy, so they spend. Okay. But if you have a market flush with liquidity, you got overstated growth, perhaps through massive federal deficit stimulus spending, and you have all this, the upper spending curve in terms of the wealthy continuing to spend, you risk that inflation goes back up, and that's kind of what we're seeing. And I think this is going to be key for markets to negotiate through. We can all hope for a happy ending to this, but because we've seen such an aggressive bull market as and I'm obviously primarily also a market technician, I see the possibility we're going to have a lot wider ranges in 2025. And the market may have some appointments with some corrective activity that is more substantial compared to 2024, even 2023, and may actually be a healthy thing. So don't count me in as a bear, but I think keenly aware of much broader price ranges in terms of downside risks than we've seen in the last couple of years. That's kind of my opening, if you will.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family.
So you mentioned the Fed, so I want to go there, and I think you're giving us a brilliant assessment, but I'm going to start with a story, Sven. I want you to react to the story. When I got into the business, I had read a lot of apocalyptic newsletters, and apocalyptic newsletters in the 1990s said we were going to have a great recession. Ravi Batra had a best-selling book called The Great Recession of the 1990s. We had apocalyptic deficits. We were going to be taken over by the Japanese. I think you and I are both old enough to know that the Japanese were buying Pebble Beach, they were buying 30 Rockefeller Center, and the U.S. was going to fall into the earth. And it's 35 years later, we've racked up about $33 trillion worth of debt over the 35 years. U.S. didn't fall into the earth. The stock market went from 3,000 to 42,000. And so the apocalyptic people got it wrong. But I'm sitting here right now looking, and I feel like there's an apocalypse coming, but maybe I'm wrong about that as well. But you be the Fed chair, and you take me inside the meeting where things are upside down. The deficit, the politicians are not going to stop spending. And so people come on this network and they rail on monetary policy, modern monetary theory. They rail on it. But we're all monetary theory. We're all modern monetary theorists because that's all we do. So tell me what's going on. Is there an apocalypse coming? Is somebody like you and me, we'll be long gone, but there's somebody like you and me 40 years from now, U.S. deficit will be 150 trillion and it'll be no problem?
I think what we're seeing now is the consequence of 16 years of interventionist central bank policy. The global financial crisis was obviously a big deal. That was kind of the moment where everything was at the brink of falling apart. And from Bernanke on forward, what the Fed has done, if you look at, go before COVID, the period between the GFC and COVID, what happened? Every time there was any sort of trouble, and by the way, Bernanke, right after the global financial crisis, he was in front of Congress and said, we're going to get the balance sheet back down to below $1 trillion. That's what he was talking about. And of course, he then proceeded to get it to $4.5 trillion, right? Because they started going back to the well and they kept intervening, QE2, QE3, QE4. We all know the history. And then, of course, COVID happened, and boy, did they react superbly quickly. The issue is that we have never allowed, or the Fed, has never felt confident enough to let the system cleanse itself. And if I look at markets now in terms of just traditional metrics, i.e. the market capitalization versus GDP, we came into Q4 at over 200%, and obviously the post-COVID excess where they threw everything at it, fiscal, monetary, MBS purchases through the roof, we got to 200%. We'd never seen anything like that. And of course, I know that, we've big international tech companies, you can argue maybe the standard metric is a bit outdated, but the fact is the valuations are where they are. I mean, Apple, price to sales of 10, PEs, all of these guys are in the 30s. I mean, Apple, for just an example, in 2017, Apple was the first company to hit $1 trillion market cap. That was a big deal. It took them a long time to get there. In Q4, we had 3 companies at $3.5, almost $4 trillion in market cap. I mean, the market cap expansions that we've been seeing in the last few years are just stunning beyond belief. Ultimately, you would think there has to be a fundamental story that supports these valuations, or expressed in a different ways, you can hardly afford accidents. The point I'm making is the entire system has become ever more financialized, and it's ever more dependent with each other. If you have a major drawdown in financial markets, you're going to end up in a recession. The market is so much larger than the economy now. And so my view is policymakers are fearful of what would come. I mean, maybe you could have handled this a bit better than 10 years ago, but now everything is even more extreme. So everyone is afraid to cause that reckoning, right? And so you got Powell and you got Yellen, for years they've been saying the same thing. These deficits are unsustainable, yet, they've been continuing to support what has been happening on that front. You cannot have a politician today, be it Biden, be it Trump, be it anyone in leadership, says we're gonna really cut down spending. Everybody is a deficit hawk until the stock market crashes, right? And unfortunately, and this is one of my larger macro concerns globally, by doing that, who is benefiting? Well, we know 90% of the assets are owned by the top 10%. The wealth inequality, the wealth gap, it's been getting worse and worse and worse and worse from cycle to cycle. Classic example, last year, the top 10 billionaires got $750 billion in additional wealth bestowed upon them. while homelessness is at the highest level ever, according to some of the news items I've seen. And one reason, people like to think, these guys were bad, so now we're going to fix everything. The reason we're seeing governments falling like dominoes everywhere in the Western world is because of social discontentment. That's why I think Trump just won again. That's why in England, the Tories got kicked out. That's why in Germany, Scholz is getting kicked out. That's why in France, we have political trouble. We see that everywhere because a large swath of the population is struggling. And so I would argue, and maybe this is maybe not a very popular thing to say, but have central banks with their constant interventions and towards the express benefits of financial assets prices, have they contributed to social and political instability? Because they are directly driving this wealth gap. Sorry to say. And I think even, Druckenmiller mentioned that as well in terms of the Federal Reserve being the biggest driver of wealth inequality. I mean, where is this heading? How is that going to have a happy ending? I'm asking, because the trend has been the same and it's getting ever more extreme. And we do see now, globally, as I just mentioned, signs of global political instability. And how do you govern societies? How do you make policy when you have large swaths of the population getting ever more fragmented, where you cannot agree on a common reality? And there's complex problems that no one can tackle because there's no cohesive political way to solve these problems. And so in the meantime, everybody comes in and relies on the same well to keep the illusion up, if you will. So that is a structural concern. And at this point, I hear now from Elon that he wants to cut $2 trillion in government spending. Government spending is out of control. Totally agree with that. But I don't know how much of that is realistic, given how government is structured, how much there's in mandatory spending. And so I suspect that the answer is deficits until something breaks, until they can't handle it.
It's interesting because the government is set up where they get the increase. If they don't spend the increase, they can't get more increases. So they're incentivized to spend the money on very wasteful things. So, but it seems like a daisy chain that continues. I guess neither one of us knows the answer to this, but it seems like it's going to continue for longer than people had projected. 30 years ago, they said it was coming to an end. It's 35 years later. Here we are. I guess what I would like to ask you about is, because I know you write a lot about this, the geopolitical tensions. We now have the president threatening Panama, President Trump. He's threatening Panama, Greenland, and he's threatening Canada. I don't know. I mean, a lot of my friends on Wall Street voted for Donald Trump. And when I said to them, well, okay, so what do you think he's going to do? Well, he's not going to do what he says he's going to do. Oh, okay. So you voted for somebody so he's not going to deport 15 million people. He's not going to have 600% tariffs on China. He's not going to invade Greenland. Like, okay, so what is he going to do? And how do you think the geopolitical situation gets resolved or exacerbated over the next year?
That's a very good question. And I think it's fair to say, and I think everybody should be humble about that in terms of the lack of visibility, in terms of what actually gets implemented vis-a-vis what is rhetoric. And obviously what ultimately matters is what does get implemented. Obviously we're all witness to the first Trump presidency. My personal impression, I think he cares about the stock market very much. It's one of his benchmarks. Actually, from that perspective, if I were him, I would have probably wanted to have seen a larger correction going into the inauguration, because, you always see the previous presidential track record and then you have yours, as a measuring stick going forward. And as I said, valuations are very high. And this is where kind of the last few weeks are interesting to me, because, Yellen and Biden basically had an unlimited credit card for the last few years. And Yellen just came out and says, guess what? We're going to hit the debt ceiling here in January. And hence, I think it was no surprise, Trump came out and says, I want that too. We got to increase the debt ceiling again. And I think to your earlier point, they're all going to do it. They have no choice. No one has a choice. You cannot fathom the pain if that would ensue if that debt ceiling wasn't kicked down the road again. So yes, it's going to happen. I think ultimately Trump will definitely want to push tax cuts, certainly extend the ones that came from his previous administration. To the extent that he can push in more, obviously that's going to be increasing the deficit again, right? So where the only way you can solve the deficit is you got to have real structural growth that's not driven by liquidity and deficit in itself. But you can't have that with yields where they are now. I think if yields stay as high as they are, the 10-year heading here precariously close to 5%. Let's not forget, despite all the liquidity and all the distortions, there is still fundamentals. There's still a business cycle out there. And if we stay on this path, in terms of, the longer we stay on this path here in 2025, I think the recessionary risk is actually increasing. And there are plenty of disturbing facts one can point to that haven't mattered so far, but that's what happens in every cycle. We always get to that. 2007, right? Even the Fed didn't believe it because everybody doesn't want to see the bad downside, right? We are conditions for that because the bad news items get over-trumped by the enthusiasm. I mean, look where we are now. This is kind of wild because, not only do we have the most valued stock market, but the most concentrated stock market. Retail has higher exposure to asset prices than ever, and everybody's the most optimistic about 2025. What can possibly go wrong? That's kind of one of my structural concerns where I say, maybe we are due some more spankings this year to kind of, shake things up a little bit. Just everything is too one way, too optimistic and what have you. Now, counter side is, as at the beginning, $1 trillion in buyback coming in again, and maybe tax cuts. Those are all positives for corporations. But I'll point to one particular item that I think could cause a major hiccup this year. And that is the reverse repo I mentioned before, because it got down to below $100 billion in Q4. And that thing is going to run out. It's going to get to close to zero. And then a major source, one of the big three legs of liquidity that has aided the stock market since October 22 is gone. So what is the Fed going to do? And they've been conspicuously quiet on that. And I suspect if we do get these larger drawdowns this year, the Fed's going to step in every step of the way. And in regards to yields, one of the Fed speakers this week actually pointed to, we're going to fix this. He didn't say how are they going to fix it. I think it was Bauman. But it started smelling like yield curve control to me. And reverse repo, if that runs out, they can flip the switch on QE again, right? And by the way, the quickest way to solve high yields is slowing growth, right? So if you head towards a recession or growth slows dramatically, boom, yields are going to go down, which ironically then may be a bullish effect on some of the laggards like small caps and so forth that have not partaken so much in the stock market rally.
You've made some bold predictions in the past. So give me a few bold ones before I go to audience questions.
Bold ones. BIX 36, maybe it's not that bold, but from a technical perspective, I love the VIX. In our age of ODTE, people like to dismiss the VIX in many ways, but it left a big gap in August from that big spike that we had. I think that'll ultimately get filled in 25. I wouldn't call it a dramatic prediction, but I'd say the S&P has an appointment with the 200 MA. That is around 5,500 right now. When that happens, I don't know. Earnings will be interesting here in Q1 because the dollar has rallied so dramatically, right? And don't tell me every multinational corporation was perfectly hedged against a 10% move in the dollar in 4 months. Okay, so there's maybe some consternation with that, and maybe that'll be the trigger to get us to the 200. And maybe we'll initially probably get bought. One of this may sound mundane, but it's a really interesting indicator. I love the exponential moving average, the 5 daily, the 5 weekly, the 5 monthly, 5 quarterly, and the 5 yearly. And if you paid attention to the yearly 5 EMA, it's been tagged in every bull market. It just always support, always support, always support. Last year we didn't even tag it because the market was so persistently going higher that it connected with the S&P after the fact. Interesting. Well, guess what? That thing is around 5,000, 550, 100. Okay. If we were to drop all the way to there, unless you close the year below it, you're still in the bull market, but guess what? That would be a 20% drawdown. Would probably be a great buy if that happens this year. Don't know if it's going to happen, but I'm open to it. Okay. So I think we're going to have to negotiate a lot of ranges through, stay open-minded. I'm basically viewing 2025 as a trading year in the sense that, unless we get big drawdowns, everything's a trade. If we do get big drawdowns, then we can have more of an investment horizon. And then, of course, depending on what Fed response is said. So for now, trading environment, always looking at the long side, but also scaling out when the risk-reward equation changes. And so we'll see how this floats here in the first quarter. But, policy in terms of what has been announced vis-a-vis what actually gets implemented, we all need to stay open-minded about, because those could be quite different things.
What's your Bitcoin price prediction for 2025 before I go to audience questions?
Well, Michael Saylor and I had a few podcasts back in the day, and the last one we had was when Bitcoin was dropping below 20,000. And my wife had a prediction then that it would hit 100,000. It did. She now has a new prediction, which is 150,000. I think. Oh, look, deer behind me. If you look closely, I got a.
I see it, yeah.
Yeah,
it's still light out. You're doing beautifully there in London. I see the deer behind you.
Yeah, that's cool. Like, nice to see him live. The thing with Bitcoin, obviously, if we are going to an SBR, I guess my question would, if the government steps in and buys Bitcoin, yeah, then, sky's the limit, I suppose. But given deficit spending, I also kind of question, where's the money coming from? So it has to go on some book somewhere. This latest run-up has come on fairly big negative divergences, so I would not be surprised to, like the S&P, to see actually some larger drawdowns this year, and I'll tell you why. If you look at a monthly chart of the S&P vis-a-vis Bitcoin, there is a 92% directional correlation that has gone over the last 10 years, and it's all driven by liquidity. Okay, when the Fed's tightening, everything goes down. When the Fed's easing or the liquidity equation is positive, everything goes up. That's why I'm saying with like reverse repo, what have you, don't be surprised if there's drawdowns. At the end of the day, it's still about liquidity. In terms of Bitcoin reserve, that's again one of those policy things that's out there, but it's not real yet. And given that we're also hitting the debt ceiling here in January, those things will have to be negotiated through as well. So, don't count on things that don't exist yet. Once they exist, then we can definitely talk about them.
Okay, let's take some audience questions. I think you're always so brilliant and thorough. Your career spans a few market cycles. What's one belief about markets you held early on, Sven, that you've since completely changed? This is Lucas from California.
That fundamentals matter more than anything else. No, the big lesson for me, and I've been guilty of this myself over the years, is that liquidity trumps everything. And if you're not aware of the liquidity drivers, you're going to find yourself fighting the tape in a major way. I think financial market. This is, I said this a couple of times last year when I put out some charts. This is not your daddy's market. When we see companies expanding their market caps by several $100 billion in 10 minutes, on some news flash, right? This is a different ball of wax. So having said that, though, when things get really emotional in markets, when they get hyper, either on the negative side or the positive side, the thing that keeps me honest and emotionally detached, which I think is really important in markets, are the technicals and the charts. And I'm not saying, I'm going to buy every bottom or I'm going to catch every top or what have you, but it's very clear to me when the risk reward equation is shifting. And, I'm not going to establish new longs given certain parameters in place. The biggest skill set I think any trader can match, and it's also the hardest, is patience. You got to be able to wait for your setup and then execute on it. And you also need to be aware when your setup is no longer valid, because nothing is guaranteed. You can see a potential setup that looks beautiful and it just kind of fizzes away. Well, then don't chase it, right? But once a setup is working and it's confirmed, then stick with it until the risk reward equation changes. So that's why I, to this day, still love technicals. And these markets, despite all the distortions we talk about and all the influences, they're still very technical. And don't forget, the algos don't go willy-nilly either. They're also respecting technicals. They're programmed for that reason.
Let's go to the next one. You have a 10-year investment horizon. What sectors or strategy would you recommend focusing on? This is Sarah from your neck of the woods, the United Kingdom.
Hey, Sarah. Well, you're asking the wrong guy because, that the handle is NorthmanTrader, not Northman Investor. I don't have 10-year investment horizons. And given where valuations are generally at this point, I definitely don't have an investment outlook. I can look, for example, to the UK, the FTSE, and given what actually has happened in the last 10 years, this rush towards equities has been predominantly beneficial for US equities. And so the US market is now, over 50% of global equities. And, we're talking about multiple concerns in the US. By the way, one of them is Gap. Gap earnings last year ended up over 30. If you look at the previous bull markets, early 2000, mid 2000s and following, your Gap earnings ratio ranged from 16 to 26 on the extreme. We're already way beyond that. So it's all kind of squeamish. But you look at, for example, the UK or Germany, their multiples are much, much, much lower. So, there may be some longer term opportunities there. And yes, all these countries have issues. Everybody has issues. No question about that. But, you may face less of a valuation drawdown risk there vis-a-vis, for example, the US.
Let's go to the next one. How should I approach risk management when investing in volatile assets like Bitcoin? Mark from Texas.
Well, I'm a big believer in stops. And not using leverage. Stops can be a pain in the butt, especially if you're in a positioning process, because the tape can be very volatile, but your risk is very well defined. And you obviously set your own stop size, so you know what that risk is, right? And then one of the techniques we've been using over the years, which we like, is once we are in a position and the trade plays out, we also not stubborn, meaning, we're not going to ride it all the way to the top, whatever the top may be. We're going to employ a scaling process. Okay, so as the position goes in profit, we close a scale, right? So we're starting to build flexibility and cash again, right? And then when the trade when the risk reward is completely shifted, then we close the position. And that way we always have a continuous process of flexibility building. But there are times when we are aggressive and say, well, this is, for XYZ reasons, this is a really interesting area that we're interested in pursuing. So yes, we'll use stops, we'll get aggressive here, and we'll take the stop pain at that point. We can always readjust.
All right. Let's go to the next question. What are your thoughts on the potential of AI and automation to reshape the workforce and the economy over the next decade? John from New York.
The potential is enormous. I have no question about that. I mean, I can see where large swaths of jobs will just go away. I'll give you one example. I mean, call centers. I mean, if you got AI, plugged into all the processes and intelligently enough be able to converse, I think a lot of us, if we ever have a customer service issue, we get stuck in call loops. We wouldn't mind seeing that change. Any places where companies can become more efficient and obviously then save on their expenses in terms of the labor force, I think there's definitely risks there for the employment picture to shift dramatically. I'm not an expert on this. I can just go by what I've experienced, which is very little. But look at Grok on Twitter, right? 6 months ago was just absolutely awful. I mean, this gave me constantly the wrong information, the wrong context, and I couldn't use it for anything. I would be relying on it for anything. I would credit to Elon. I'd say it's improved quite dramatically. Is it where it needs to be? Probably not. But we're still very early on this, and then clearly, the big boys are investing big time into that. So I'll stay open-minded about where these capabilities are going. But I think none of us can stay complacent in terms of assuming the job market is going to stay stagnant the way maybe it has been. There's going to be changes.
All right. Well, listen, you've been incredibly thoughtful, and we beat the sun down in the UK, Sven. See that? All right. You get great lighting. Still have great lighting.
And we saw deer. We didn't even have to go anywhere.
You saw deer. Also, it's a beautiful home you have. God bless you. And let's keep up the good fight in 2025. And hopefully you'll come back on Speak Up for us. Thank you so much for being on with us.
Thanks for having me, Anthony. Good luck in 25 as well.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to Wealthion.com and sign up for a free, no-obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. And if you could like and subscribe to the channel, we greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.